Welcome to this video where we will examine what things are included in creating a credit score. To save money and get the best interest rates, it is important to maintain a good credit score. Credit scoring systems calculate all of the information on your credit report into a number which represents your credit worthiness. The most commonly used scoring model is FICO. The FICO score measures consumer credit risk and has become a fixture of consumer lending in the United States. The FICO model ranges scores from 300 to 850. The credit score rating scale is what lenders and other creditors use to make decisions about what interest rate you will receive when applying for credit or a loan. The higher your score is, the better interest rate you will get. FICO scores include points given for the following 5 pieces of criteria. Number 1. 35% of the score is based on payment history. This is all about making on-time monthly payments. Even one late payment can really hurt your credit score. FICO looks at the most recent 24-month window of payments, so fill it up with on-time payments for the best credit score results. Don't be late or miss payments. You don't need to carry a balance in order to build credit. The second piece of criteria, 30% of the credit score is based on the amount of debt still owed. This is all about how much debt you have compared to how much credit you were allocated. This is called utilization. Utilization refers to the amount of available credit that you are currently using. Ideally, your utilization would be 30% or less of your available credit. For example, if your credit card has a credit limit of $1,000, you would want to keep your balance below $300 at all times if possible. If you are maxed out or over the limit, this will also hurt your score. 15% of the credit score is based on the length of credit history. Creditors like to see lines of credit that are open for a long time and have been well managed. Anything open for 2 years or longer with good history is worth keeping. Anything closed within 2 years of opening can be harmful because you haven't reached the 24-month of payment history. The fourth piece of criteria, 10% of the credit score is based on the different types of credit. Subprime or prime, installment or revolving. Creditors like to see a good mix of installment and revolving credit. Subprime credit is typically extended to individuals with poor credit and will have high interest, high fees, no rewards programs, perhaps an annual fee. Prime credit is extended to those with excellent credit and typically has lower interest rates, lower fees, no annual fees, and might have cashback rewards or frequent flyer miles. Revolving credit is the kind you can rack up and pay down again and again. Examples of revolving credit are credit cards and lines of credit. Installment credit is the kind that has an end. So examples of installment credit are home mortgages, student loans, car loans, personal loans, etc. And the last piece of criteria, 10% of the credit score is based on inquiries. Inquiries is the list of people or places that are looking at your credit report within a 12-month period of time. There are hard pulls, which come from anyone who has looked at your credit for the purpose of extending credit to you. There are also soft pulls, which come from agencies that are looking for the purpose to market financial products to you based on what they see on your credit report. When you go to borrow money, the lender wants to know how likely you are to repay what you borrow. They use your credit score as one way to measure how likely you are to repay your loan. They also consider other factors, which are known as the 5 C's of credit. The first C stands for character. Sometimes called credit history, the first C refers to a borrower's reputation or track record for repaying debts. This information appears on the borrower's credit reports. The second C stands for capacity. Capacity measures a borrower's ability to repay a loan by comparing income against recurring debts and assessing the borrower's debt-to-income ratio. In addition to examining income, lenders look at the length of time an applicant has been at his job and job stability. The third C stands for capital. You can think of capital as another word for money. Lenders also consider any money the borrower puts toward a potential investment. A large contribution by the borrower decreases the chance of default. For example, borrowers who have a down payment for a home typically find it easier to get a mortgage. Down payments indicate the borrower's level of seriousness, which can make lenders more comfortable in extending credit. The fourth C of credit is collateral. Collateral is something pledged as security for repayment of a loan. Collateral can help a borrower secure loans. It gives the lender the assurance that if the borrower defaults on the loan, the lender can repossess the collateral. For example, car loans are secured by cards, so that if a person defaults on their auto loan, the lender can take the car back. The fifth C of credit is conditions. The conditions of the loan, such as its interest rate and amount of principal, influence the lender's desire to finance the borrower. Conditions refer to how a borrower intends to use the money. For example, if a borrower applies for a car loan or a home improvement loan, a lender may be likely to approve these loans because of their specific purpose, rather than a signature loan that could be used for anything at all. Here are some reasons why your credit score might be low. Having items in the public records section, including judgments, garnishments, bankruptcies, or tax liens. Having collections or delinquent payments on open accounts. The number of accounts with delinquency. Time since delinquency paid up is too short. Ratio of balances to credit limits are too high. Too many new accounts, or maybe the accounts are too new to rate. Having too many accounts from subprime lenders. Too many inquiries in the last 12 months. And if the length of positive credit history is too short. These are all examples of how your credit score might be low. You can build credit by doing a few things. First, pay bills consistently and on time. Second, pay down your debt load by paying more than the minimums and try not to max out or go over your limit. Check your credit report once a year and write to the bureaus to remove any errors that you may see. Avoid too many inquiries. If you are turned down for credit, fix the problem before applying again. If you don't have any credit, you can get started by getting a secured credit card until you can qualify for an unsecured card. A secured credit card is backed by your own money and reports payment activity to the credit bureaus. Once your score improves, you can get an unsecured card and get your own money back from the secured card. Remember, if turned down for credit, ask questions. Find out the reason for being turned down and what you might do in the future to improve your credit.